Europe outperformed in a significant way, and I think that has to do with the worst possible scenario being priced into to the valuations, and that's effectively what has occurred year to date. Europe has outperformed the U.S. in large cap, and I like Adam Johnson. I think nice to see you again. I think there are opportunities in the U.S., especially as we see this panic set in, but there's a price for everything, and our call on Europe is less a structural call. We're not saying that Europe has become, much more flexible in terms of its labor market, or is facing a robust economic recovery. We're saying that at some point the bad news, it can't take the prices too much lower, and that's what we're seeing. We're seeing some rebound in European equities, but I do think that the U.S. will still have a good year. My suspicion, however, Madison, is that we are seeing that short-term pain for long-term gain scenario play out. So there probably will be additional opportunities, as Adam said, to accumulate positions in strong sectors and strong names as the market potentially goes lower.
And I know that your view is that we're heading into a slowdown, not necessarily a recession. We talked about Europe, we talked about the U.S. Which sector or even specific stocks are best positioned amid a slowdown to benefit from a slowdown?
Well, thanks for asking that, because I'm very proud of my answer. My top pick coming into this year was healthcare. It's the top performing asset class. My top pick for last year was utilities. It was about the third best performer last year. I think healthcare is going to do well this year. You have to be defensive, I think, in such a volatile time for the markets with elevated uncertainty. We're not expecting recession. We don't think we're lodged in a recession at the moment, but we are seeing a shock of uncertainty, which precludes consumers from consuming, or it at least pauses their consumption. Same thing on the private sector front. Investment has been paused, perhaps not halted altogether, but paused. And I think that has to do with the shock from tariffs. Now, tariffs don't have an immediate and persistent effect on inflation. We saw that from President Trump 1.0 and the ensuing impact on inflation from his first round of tariffs. But they do, and historically have proven to be the case, have a very negative effect on the markets. So we should anticipate some volatility. And that's why I've been recommending the purchase of protection with protective put options. And now what we see today, Madison, is that we have record volumes of puts. So those puts are attractive when the VIX is low. They become much more expensive when everybody wants them.
Kathryn, it's wonderful to see you again. And you're very good at the macro, much better at the macro than I am. I tend to be a stock picker. So I'm hoping you can help explain something to me and maybe even our viewers. How is it that the Atlanta Fed has come up with this GDP now forecast that says the economy is contracting 2.8%? When I look at my individual companies, I don't see anything like that. But can you help us understand that?
Yeah, I couldn't agree more, Adam. It's shocking, the swing that we saw in 4 weeks' time. We saw that now that Atlanta Fed nowcast predict the first quarter U.S. real GDP grow at 3.9% positive. To 4 weeks later, revised down to negative 2.8 and subsequently revised to negative 2.4. The reasons they cite are front loading of imports. And that's a natural occurrence. We saw that in Trump 1.0 as well in 2018. We actually saw a very similar situation in the economic front as in 2022, and we saw the first quarter come out negative, and it was the only negative quarter of growth. You have a front loading of imports to avoid, of course, higher prices down the line. And then you've also seen, and this is according to the Atlanta Fed data, the five regional Fed banks saying that they are seeing less interest in capital investment. So that might be a concerning trend. The third thing, of course, was the January personal spending number that came out the lowest in about a year, negative print. So those are the three things that the Atlanta Fed pointed to. But I do think that's a tremendously volatile swing and something to be aware of. But really, we would have to see more trend data than simply January data. I'm looking forward to seeing additional consumer spending data going forward.
Oh, thank you, Maddie. Appreciate that. I guess I get one more question from you, Kathryn. The Fed is going to have their meeting on Wednesday. What would you like to hear from Fed Chair Jerome Powell?
I'll tell you what I'd like to hear, but I think what we're going to hear is that they're on wait and see mode. I think they're going to talk about being cautious. I think the Fed is not going to even consider cutting rates until the end of this year. And unless and until we see a move higher, a meaningful move higher in the unemployment rate and a serious drop off in consumer spending, the Fed is unlikely to cut anything further. I think the Fed might even talk about stagflationary risk. Of course, that's sticky inflation with decelerating economic growth. And in that environment, Adam, I don't think that the Fed is going to be cutting anytime soon.